Imagine waking up on a Monday morning, checking your bank account, and realizing that your car has quietly become the most expensive thing in your life after your home, even though it spends most of its time parked. You make a monthly payment whether you drive it or not. Insurance renews automatically. Maintenance arrives without warning, fuel prices fluctuate beyond your control, and every mile reduces the vehicle's value. At some point, an unusual question begins to feel surprisingly reasonable. What if it actually costs less to stop owning a car altogether and simply pay for rides when you need them? For a growing number of Americans, this is no longer a thought experiment but a financial calculation. And while the answer depends heavily on where they live and how often they travel, the mathematics behind the decision reveal something much larger about the changing economics of transportation in America. For decades, car ownership represented freedom, stability, and adulthood. Entire suburbs were designed around the assumption that every household would own at least one vehicle, often two or three. Jobs, schools, grocery stores, and healthcare became increasingly spread apart, making driving feel less like a choice and more like a requirement. Because nearly everyone accepted this reality, few people stopped to question whether owning a vehicle remained the most efficient financial decision in an economy where transportation options were rapidly evolving. The psychological side of car ownership is just as important as the financial side. Most people think about the monthly payment because it is visible, but the human brain tends to ignore costs that appear gradually over time. Insurance is billed separately. Registration arrives once a year. Oil changes happen every few months. Tires last several years before suddenly requiring replacement. Unexpected repairs appear without warning. Parking fees accumulate one trip at a time. Each expense feels isolated, making it easy to underestimate the true annual cost of keeping a vehicle on the road. This often described this as mental accounting, where people separate expenses into different categories instead of viewing them as one complete system. As a result, many households know exactly what their monthly loan payment is, but very few could accurately estimate how much their vehicle actually costs over an entire year. When every expense is combined into a single number, the picture often looks very different from what people expect. Consider a simplified example. Imagine someone finances a modest vehicle with a monthly payment of $500. Insurance costs another $200 each month. Fuel averages $150. Routine maintenance spread across the year adds another $100 per month, while registration, inspections, parking, and occasional repairs contribute even more. Even before accounting for depreciation, the vehicle may already cost well over $1,000 every month. Depreciation is often the largest invisible expense because no money leaves your checking account directly, yet the vehicle becomes less valuable with every passing year. A car purchased for $35,000 may be worth significantly less only a few years later, regardless of how carefully it has been maintained. That loss in value represents real wealth that has disappeared, even though it never arrived as a monthly bill. Now compare that with someone living in a dense urban neighborhood who works remotely several days each week. They may only need transportation for grocery shopping, occasional meetings, social events, and airport trips. If they spend $400 to $700 each month on ride-hailing services, public transportation, and occasional car rentals, their annual transportation costs could still remain below the total cost of owning a personal vehicle. In this situation, selling the car is not necessarily about avoiding transportation costs. It is about replacing fixed expenses with variable ones that better match actual usage. This shift reflects a broader economic principle known as asset utilization. An expensive asset creates value only when it is actively used. A privately owned car, however, spends the overwhelming majority of its life parked. Owners continue paying financing costs, insurance premiums, depreciation, and registration regardless of whether the vehicle is moving. Ride-hailing services distribute those ownership costs across many different passengers throughout the day, allowing each rider to pay only for the portion they actually use. Of course, this equation changes dramatically depending on location. Someone living in a rural community may drive dozens of miles simply to reach work, schools, or essential services. In that environment, relying entirely on ride-hailing could become impractical or significantly more expensive. The same is true for families with several children, irregular work schedules, or limited transportation alternatives. What appears financially efficient in one city may be completely unrealistic somewhere else. The decision also reflects changing lifestyles. Remote work has reduced commuting for millions of Americans, meaning some vehicles that once traveled hundreds of miles every week now remain parked for days at a time. As annual mileage declines, fixed ownership costs become a larger share of every trip. When a car is used less frequently, every individual journey effectively becomes more expensive because the ownership costs remain largely unchanged.